So let's begin. We have a lot to cover, so I don't want to much delay, but this will be recorded, so it will be available on YouTube as well. Good morning or afternoon, depending where you are. My name is Verônica. I'm the Institutional Relations Manager at BMJ, and I'm glad to be moderating this event. It's a very important issue to Brazil. We are discussing relations with our main partners, and it's important in terms of foreign relations, but also in terms of economic policy. We're discussing trade policy, investment promotion, industrial development, and of course, economic recovery from what we've seen in the past months and years, actually. The background of this debate is, of course, the pandemic, these very odd times we're living in, surrounded by a high level of uncertainty. And on the one hand, we have China coming out stronger from the first year of the pandemic with a growing economy. Xi Jinping is the most likely successor to himself in 2022. We have China's 2 sessions taking place this week, ending this Thursday, and it should give us important hints on the political and economic priorities of the country for the coming years, being a very pragmatic and long-term planner. And we have already the announcement of a GDP growth target of more than 6%. And among the 5-year plan that should be approved this week, we have interesting things like the continuity of the Belt and Road Initiative, the ratification of the agreement on investment with the EU, and improving China-US relations. On the other hand, in the Americas, we are struggling to overcome the health crisis and to promote economic growth. We have a new administration in the US setting a whole new tone with many measures being enacted since January. And all of this only becomes more interesting or dramatic in Brazil, where the political environment changes every week. So before I pass on to our speakers to discuss this very challenging context, some technicalities. I'll ask everyone to keep microphones on mute during the presentations, except for the speaker, of course. Questions can be sent through the Q&A chat, and I'll be happy to read them if we have time at the end. And this event is being recorded, as I said. It will be available on YouTube. And finally, we have an interpreter online with us, so you can choose. I think there should be an option for you to choose the language. You only need to click on it, and you can hear this presentation in Portuguese. So let me introduce our guest speakers. Dr. Stephen Kaplan is an associate professor of political science and international affairs at George Washington University. Currently, he's working on his second book, which we'll hear about, Globalizing Patient Capital, the Political Economy of Chinese Finance in the Americas, which is forthcoming this spring with Cambridge University Press. The book examines China's overseas financial investments in the developing world. It assesses how China's state-led capitalism, a form of patient capital, characterized by long-term risk tolerance and a lack of policy conditionality, affects national level governance across the Americas. Kaplan has also written extensively on Argentina, Brazil, Chile, and other Latin American countries on how relations between international creditors and national debtors affect economic policy choices. Previously, Kaplan was a senior economic analyst at the Federal Reserve Bank, where he wrote on developing country economics, global financial market developments, and emerging market crisis. Thank you very much for joining us. And Dr. Barral is BMJ's founding partner and current senior counselor. Barral focuses on international trade and international investment issues. Besides that, he has over 30 years of experience as a consultant for multilateral agencies and companies in Latin America. Barral was Brazil's foreign trade secretary between 2007 and 2011. Currently, he's a director in the Foreign Trade Department at the Federation of Industries of São Paulo, Fiesp, and an advisor to the American Chamber of Commerce in Brazil, AmCham. Previously, he was an arbitrator at the Mercosur Permanent Review Court and the WTO Dispute Settlement System, as well as a visiting professor to several universities in Brazil and abroad. So without further ado, I pass on to Dr. Kaplan for your opening presentation. Then I ask you to pass on directly to Dr. Barral, and I'll come back at the end for the round of questions. Thank you.
Thank you very much, Veronica. And thank you very much to both BMJ as well as the U.S. State Department Speakers Program. Tremendous privilege during circumstances like these to still be able to connect. So thank you to everybody for allowing that to happen. All right, so I'm going to share my slides with you. And today, as mentioned, I'm going to be presenting some of the ideas for my forthcoming book related to Chinese finance, how it compares to US finance, and what it means to some extent for countries triangulating, right, between these different forms of finance. What are the costs and benefits? So effectively, if we look at the following chart, right, China as an emerging global creditor, you can see since the last global financial crisis in 2008, right, China, in terms of the amount of banking, right, it does cross-border banking internationally, really increased quite a bit. Brazil also does, right, some international banking as well. China was pretty close to similar levels to Brazil, right, prior to the crisis, but they used the opportunity of the global financial crisis to really increase financing investment globally, and particularly within Latin America. There were regions like Africa that China had already been investing in, but really since this threshold of the global financial crisis, we see this increase in Chinese financing. So some of what we're going to look at is what are the motivations behind this form of financing? How does it compare to Western creditors? And what are the implications, right? Particularly for sovereign borrowers within Latin America and Brazil. So in terms of grand strategy, right, basically we have policy banks within China, including China Development Bank and China Exim Bank. And, there's this long-standing strategy, right, that we're all kind of familiar with in terms of China looking to improve access to commodities, raw materials, and energy supplies globally. There's also elements, right, that gets a lot of press too about soft power, right? To what extent does this form of development finance or South-to-South cooperation, this theme of empowering developing countries, how much of this is maybe to some extent about soft power as well, right? So there's kind of these IR grand strategy themes when trying to think about motivations that scholars have talked about quite a bit. But there's also sort of more from a commercial standpoint, right? There's sort of what China's really trying to do over the long run. And in a lot of ways, what they're trying to do compared to, I'd say, what banks do in the West, right? What banks do in the West often reflects bankable projects, right? Individual profitability of a project, right? If we start thinking more in terms of what China is trying to do from kind of a geoeconomic standpoint, in a lot of ways, they're trying to maximize markets rather than necessarily just maximize individual profitability. So where we came out initially of the WTO after China had joined, and they were using sort of, to some extent, an undervalued currency, a cheap currency to promote their exports. With the Go Global strategy, right, that emerged sort of later on in the 1990s, sort of at the tail end of the 1990s, they start slowly shifting towards using their reserve accumulation to instead promote exports abroad through investment in financing, right? So increasingly, the strategy becomes about, rather than just export promotion through an undervalued currency, increasingly, right, using their reserve to instead promote markets abroad and maximize opportunities within those markets, right? Maximize opportunities for Chinese contractors, suppliers, and workers, right? Gain valuable experience overseas in marketing, distribution, logistics, local engineering, and even internationalizing the renminbi through these commercial transactions, right? So the strategy shifts compared to the early days coming out of the WTO. Now, embedded in this strategy, it looks a lot like an East Asian development model, but there are some differences in terms of where the emphasis is, right? So first of all, I think traditionally in the West, when we think of inputs into economic growth, we think of labor, we think of capital. In a lot of ways, China thinks of infrastructure as an input into growth, right? A lot of times, I think in the West, there's skepticism, right, of new infrastructure projects. There's feasibility reports. There's a lot of things that have to be done before you rationalize an investment project. I think in China, there's more of a willingness to let infrastructure lead and let that create, from their perspective, multiplier effects in terms of trade and the economy, right? So oftentimes you see infrastructure alongside of trade deals, right? And the idea of trying to let all this package multiply out into the economy, right? Creating investment, et cetera. So simultaneously, we also see an industrial policy where government is also investing in the Chinese government innovation, providing market intelligence, technological transfer, right? Trying to maximize the ability of their firms to succeed internationally. So effectively, we see, if you look at, again, since the global financial crisis in this graph, we see all these different flows increasing simultaneously, right? Again, in the West, oftentimes we think of things disaggregatedly. There's aid, there's bond and equity investments. Hey, there's FDI over there, and it's all disaggregated. Here, it's very much in a package to some extent, all with a concerted effort to kind of maximize markets abroad, right? So you kind of see all these different measures from bank lending to FDI to trade increasing simultaneously. Now, how does it compare, right? Is Chinese credit any different from Western credit? What I find in the book and what I call patient capital is a combination of three factors. One, a long maturity structure, right? Very similar to other bilateral lenders, right? China has this longer maturity structure, but the scale makes it very unique, right? No one else is quite lending on that same scale. The average maturity of Chinese loans is about 17 years compared to about 5 years of private creditors. And at the same time, you tend to have high risk tolerance, right? Particularly early on when they're trying to build a market presence, right? So again, they're going out, they're providing financing, but the idea is that can kickstart this financing through policy banks, the effort to gain cheap assets, market shares, key logistical skills abroad, right? So you see, even during times of a downturn, oftentimes, here's Brazil, and this is Chinese foreign direct investment into Brazil. So during crises where you might anticipate capital moves out, we often see these patterns in 2008, right? 2014 with the commodity downturn, with the car wash scandal in 2015, we actually often see the Chinese investors come in and treat it as a buying opportunity, right? So oftentimes during these crises, FDI is going up a bit rather than going down. Now, often it's not greenfield investments, right? A lot of these investments tend to be brownfield investments, right? Mergers and acquisitions, but there's often interest in these kind of buying opportunities. So there's a risk tolerance that's a little different. And finally, there's a difference with conditionality, right? Where the West tends to, whether it's kind of coming from the private markets, coming from the World Bank, coming from the IMF, there's often kind of the benchmark of policy conditionality, what's happening with macro policy. Comparatively, China offers sort of this idea of non-conditional lending, but I put a question mark there because, as you'll see in a moment, it's not necessarily non-conditional, right? But effectively, right, there's this idea of non-intervention in domestic affairs, that they're not going to, attach conditions and policy conditions as part of their lending. However, what we have instead is what I call commercial conditionality. So their financing is instead secured by loans that are collateralized by future commodity deliveries, guaranteed contracts with Chinese firms, contractors, and suppliers, commitment to buy machinery, right? And this is where it has really important implications for the world of trade, right? Because essentially, they're using this financing as a way to maximize markets, promote their opportunities abroad. So the cheap financing is often, right, what gets the big headline and the scale of that financing, but there is a cost and benefit there, right? And so even though there's not policy conditionality that you get from the West, you do get sort of a fine print that sometimes without transparency can get obscured, where there is kind of a tide aid element to this, right? In order to try to maximize, like any other country, right? That's not unique to China, but maximize Chinese presence internationally, right? And so in a lot of ways, when you're talking about the cost and benefits of these two forms of financing, it does come down, as we'll see a little bit later, to local content, right? And bargaining for local content in a way that even when it's financing, you have to be thinking about commerce and local content, right? And I think that's one of the key ways it may differ from traditional Western financing. Now, what we see here in this graph is many countries within Latin America have to borrow internationally. So what we see in the graph here is this dark line at the bottom are Chinese bank loans. And we can see as a share of GDP that those Chinese bank loans since the crisis in 2008 have gone up, right? As a share of GDP, it's much regionally is about 5%, right, on average, compared to other types of, financing. Bonds is still overwhelmingly, that's the gray line, the main way that governments tend to finance themselves internationally. But as you can see, Chinese policy bank loans are on par with other sources of multilateral loans now. So what does that mean, right? What I find is that has implications for national policy making, right? Because it's starting to account for more and more of the external financing picture. So sometimes, right, Chinese loans go through the state and state-to-state relations. Sometimes they go through the market. This graph shows Latin America and the share of state-to-state loans relative to the share of market-oriented loans. What do I mean by market-oriented loans? Well, state-to-state are the kind of the traditional government-to-government deals where the financing flows directly into a development fund, right? That's not what happens in Brazil, right? What happens in Brazil is much more the market-oriented side, right? Where, yes, financing may come into Brazil, but oftentimes it's within a competitive bidding structure of public procurement, and that financing is aimed at helping Chinese firms secure that procurement, right? And so that's what I mean about market-oriented loans rather than direct state-to-state loans. So Brazil actually falls much more in a category that's different from a lot of other major debtors in Latin America to China, such as the Ecuadors, the Venezuelas, the Bolivias. Now, what does it mean for those countries I just mentioned relative to Brazil, right? Because Brazil is kind of the null case here in some ways, and we'll talk a little bit more about the market aspect of this in a moment. But what I find is that the more of your total financing that comes from China, the more likely you are to have room to maneuver, right? In this graph here, it shows primary budget balance. And you can see as you get more and more Chinese financing, countries tends to be associated with larger fiscal deficits, right? Which I'm suggesting is also indicative of more policy space because you don't have policy conditionality, right? So that's something that China markets internationally, right? You don't have to worry about policy conditionality, borrow from us. And so you see here, right, effectively, that as Chinese state-to-state lending goes up, right, it's correlated, that negative number is a correlation with larger fiscal deficits in countries. Even when you remove a country like Venezuela, I still find this pattern to be true. Now, comparatively, if you look at it graphically, this is Argentina, Costa Rica, Ecuador, and Venezuela. They all had budgetary surpluses up until the global financial crisis. And once the global financial crisis hits, not surprisingly, you get a counter-cyclical response to that crisis, but it never comes back into budget surplus, right? And in fact, these blue lines are the Chinese financing that appears, right? And what I'm suggesting is the more Chinese financing you get, the larger budgetary deficits you get because there's less scrutiny, right? And more room to maneuver because you don't have that policy conditionality. So that's one side of it, right? However, in countries like Brazil, where you still have competitive bidding processes, what tends to happen is that even though China has this cheap financing, it doesn't go as low as it would via the state, right? Typically, they look at the sovereign risk premium as kind of a ceiling, right, on where things may go in competitive bidding, and they try to just come a little below that, right? So as a result, given the importance of risk premiums in this kind of environment, you still see an emphasis in a place like Brazil, right, notwithstanding some wider fiscal deficits, as we all know about following the 2014 elections, you still see this emphasis on budget discipline in Brazil in ways that you don't in other places. Of course, it's also a product of context in Brazil, right? Inflation history, lots of different factors. But you don't see, right, with the increase in Chinese financing and loans, because it's oriented towards the market, you don't see conflicting pressures in the way that you do in other countries. But what do you see, right? This is where the commercial conditionality comes in. So right here, you have number one in this category here are sort of your traditional commercial conditions that might reflect a tied aid relationship, right? Where you take Chinese loans and you have to sort of then contract with Chinese firms, machinery, kind of the typical type of tied aid, right? The black here is Chinese kind of corporate financing or market-oriented financing. The gray is a state-to-state financing. This number two here is commodity-backed loans. When they start using guarantees, land guarantees, commodity guarantees, right? Essentially assets from the state to guarantee loans, right? Or oil for loan deals, or cross default clauses, all these other ways of mitigating sovereign risk. When it's state to state, the gray here, you can see they start using those kind of conditions much more frequently to protect their investments, right? So when you think of the trade-off of, well, you have a lack of policy conditionality, cheap financing, pretty big scale. The other side of it is it comes with a whole lot of commercial conditions that, if it's state to state, involve such things as key national resources, land guarantees, jobs. And so again, this is why the local content story ends up being so important, right? That, you know, maybe if you're building railroads and you don't have locomotive production in your country, well, import the locomotives, not a really big deal. However, if you have something in terms of that railroad production that's really key, say you make railroad ties, then that puts you in a position of having to negotiate for that local content, right? And that's a really important part of this. Here's another way of looking at it. Here's Chinese commercial conditions and Chinese state-to-state financing. As you get more Chinese state-to-state financing, you also get more and more commercial conditions. So the proper way to think of this trade-off, right, between creditors is essentially policy conditionality versus commercial conditionality, not policy conditionality versus no conditionality. So the benefits, right, of Chinese financing, you get the long-term financing in a region like Latin America, where you have a big infrastructure deficit, right? Where today you have infrastructure somewhere around 0.5% of GDP throughout the 2000s, compared to 3% rates in the 1980s, right? The era of austerity, what got cut was infrastructure, right? So Latin America has this infrastructure need. Here comes China saying, we got infrastructure financing, right? The onus is on Latin America to direct it to some extent, right? Like we need railway investment, highway investment, port, airport projects, this kind of thing. But there are a lot of costs, right, that sometimes get lost in the picture, right? And this is the fine print of it. This is the commercial conditionality. So the loans are tied, as we've mentioned, to Chinese firms, products, and machinery. And similar to trade, that really comes down to, right, it's not just about the financing. There's always commercial packages associated with it. It comes down to negotiating about local content, right? Or even things like technological transfer, ultimately. Now, the potential thing to think about, too, in terms of cost is the middle income trap, right? Industrial upgrading is a key feature of China's Latin American development plan that gets a lot of talk, particularly with Brazil. Today, about 1/10 of Chinese FDI has been destined for the Latin American manufacturing sector, but most of it is actually oriented towards Brazil, about 2/3 of it, not surprisingly, given the size of the Brazilian market. So where Brazil's in a pretty good position to be able to negotiate for this kind of thing, you know, the rest of Latin America may have a more difficult time, right? And so there's outstanding question of, to what extent might these ties be reinforcing sort of industrial stagnation or you know, undermining industrial competitiveness. This is a real concern, right, that the region has out there. Also, the extent to which you have to use commodities to guarantee these loans, there's then concern about to what extent does it reinforce commodity dependence, right? So this comes into, these are not new issues for Latin America, issues that were very similar when you had sort of other creditors beyond China from the West, right? It was always about kind of industrial diversification, avoiding commodity dependence. But again, there's an element of to what extent might these patterns be reinforced by sort of Chinese investment and financing. So it's really thinking about these trade-offs in some ways, macro flexibility for greater micro conditions. I'm going to share a few graphs with you quickly, and then we'll wrap it up because I'm just about out of time. I think I have about 1 minute remaining. And so you can see sort of since the WTO, Latin America's high-tech manufacturing imports from China have gone up quite a bit. You can also see here Latin America's exports to China tends to be concentrated in commodities, right? Particularly Brazilians know that, right? There's 3 or 4 key commodities from Brazil, where even though it's from a low base, if you look at Latin American manufacturing goods exports to China, they've kind of continued to kind of come down over time, right? Here's a Brazilian picture, right? Where, you know, Brazilian primary commodity exports to China have gone up since joining WTO. We're already very high. Brazilian manufacturing goods exports are in this steady decline, right, over time. So the question on some level is, right, as you triangulate between creditors is when you're dealing with China, how can you ensure that you have greater added value, right? Greater commitment to FDI, greater commitment to manufacturing complementarities, things along those lines. That's really sort of the key questions for Brazil. Just comparatively, here's Brazil's exports to U.S. concentrated in commodities versus manufacturing. You see sort of a rebound was starting to happen after the global financial crisis, where Brazil and the United States were kind of building some manufacturing ties. That kind of, you know, subsided a bit under the Trump administration, but, you know, maybe sort of possible complementarities moving forward. The last cost that I want to highlight in sort of the remaining minute here, and I'll just share a quick graph with you from this, is one thing that gets a lot of play within the region, right? And within U.S. circles is this debt trap diplomacy. What I want to flag, and I'm happy to go into more detail in the question and answers, is that what I think really has happened here, rather than debt trap diplomacy, is creditor trap diplomacy in a lot of ways, right? Where China's new to global financing internationally. At times they've mispriced risk places, right? Such as Venezuela. That's created the greater indebtedness, right? I don't think it's been a something that China's been motivated to do, right? You know, a lot of their diplomacy revolves around South-to-South cooperation and things along these lines that would really undercut that kind of strategy. So I really think it's more an element of mispriced risk. And if you look in the case of Venezuela, for example, if it was just China that was causing this debt problem, well, China's here in the red, right? And in Venezuela, you have over 200% of indebtedness to all different sources. About 20% of it which has come from China, but also that 20% has been in a process of deleveraging since the commodity downturn. If it was really a debt trap, you would expect instead that indebtedness was going up with China. So all in all, what I would like to kind of highlight is that, you know, when you're thinking about what's happened with Chinese financing the region to date, in a lot of ways, right, as mentioned, even though you get this cheap financing, this patient capital, long-term risk tolerance, and a lot of potential positives to it, it's very important as a sovereign borrower to weigh it against these commercial conditionality and commercial costs that I've highlighted. It's also from China, there's a lesson too, right, that I think is reflective of the lesson of U.S. banks in the region to some extent too, where, you know, this is kind of you got to be wary as a creditor too, right? The old saying holds, owe your banker 1,000 pounds and you're at his mercy, owe him 1 million pounds and the position is reversed. And we see China to date in a defensive lending posture in many countries like Ecuador, Venezuela, and Bolivia, having to effectively restructure debt because of mispricing risk. So I'm happy to talk about this in more detail. Here's the book, Globalizing Patient Capital, will be coming out later this spring. Thank you very much, and I look forward to the Q&A. And I now turn it over to our lovely Brazilian representative to talk a bit more about Brazilian trade now.
First of all, it's a pleasure to be here. And I think Professor Kaplan gave a very comprehensive view about investment and loans to America in the hands of the Chinese bankers. So I'm going to focus more on trade, mostly on trade, and more as a practitioner than as an academic. And again, it's a pleasure to be here, and thanks for this opportunity to discuss some of these aspects. So just for initially some data and then some thoughts. about what's going on between Brazil, China, and the U.S., especially after the pandemics. So here we have Brazilian trade with China and with the U.S. Basically, the United States was the main trading partner to Brazil until 2016. Until 2010. It was reversed by then. And China began growing mostly because of commodities. So as Professor Kaplan mentioned, 80% of Brazil exports is iron ore and soybeans to China. And besides other commodities, mostly commodities. Trade with, as we're going to see, trade with the US is more diversified. It is still more diversified. In the case of China, our exports here is US with China. And in spite of all the Trump's administration discourse about leveraging trade with China, you can see that there is a structural deficit that is not going to be reversed in the near future. In the case of Brazilian exports to the US, we have iron, steel, oil. Oil is becoming increasingly relevant for Brazil as a producer, not only to the US, but to other partners, and then coffee and chemicals. And we import refined oil or some machinery and also coal from the US. And when we look at trade agreements, we also see a very different prospect. The United States had an expansion of trade agreements in the last years, especially since the Bush administration. And China is expanding quite now. So China had recent achievements like the RCEP, which in fact was a way of enjoying one opportunity that the United States did not participate in the Trans-Pacific Agreement. Whereas Brazil has most of its agreements within the Mercosur framework. So most of our agreements, it's negotiated with all the other Mercosur members. And then we have partial agreements with Mexico, for example, or with India, which are in fact very limited. Most of the Brazil's agreements are within the so-called ALADI framework, which is the Latin American free trade agreement that was created in 1980, and it is still very limited compared to the overall reach of Brazilian exports. When we look at the measures that were adopted during the pandemics, what we see here that there are measures adopted mostly on healthcare and drugs related to the pandemics, but many measures were adopted liberalizing, meaning reducing tariffs. In the case of Brazil, Brazil adopted a special regime reducing tariffs. There was some export ban at the initial of the pandemics that was mostly eliminated along the pandemic. So it didn't really become a protectionist issue along the pandemic. And then talking about the Brazilian economic scenario, Brazil is in fact having another lost decade like we had in the 80s. So we had a very high growth until 2010. Then after that, the crisis, then we have the Dilma administration with a loss of 7%, almost 7% of our GDP in 2 years. We never recovered from that. And then we were affected by the pandemics last year. For this year, there is an expectation of at least 3.3%, which is small compared to the last years and compared to the low basis that we are talking about. So the consequences of this scenario is that Brazil left the top 10 economies in the world. So now it's we had a decrease on family consumption, an average family consumption of 5.5%, a very high unemployment, almost 14% of unemployment in the government, a reduction on government consumption, which is extremely relevant for the country, and the only sector, so the services sector was very affected, and this is still being affected by the second wave of the pandemics. The industry was affected, and the agribusiness was the only sector that really grew in 2020. It grew 2%. thanks mostly to China, thanks mostly to our exports of beef and poultry, for example, that grew along this period, and pork that grew along this period, and showed an important growth. So what are the prospects for this year? As I mentioned, we are probably going to grow 3.3% for 2021. Unemployment is still very high, and there's this risk of inflation. So Brazil is always struggling with itself and its institutional limits regarding reforms that have to be done, and the slowness of our political process. Political process that next year we have to face another election. So most probably many of these reforms that are being proposed in Congress will not be advanced, will not be approved this year, and will be left for the next administration, unfortunately. When you look at this economic outlook, what is the prospect for recovery? So there's a decrease of incentives in spite of a new social program that's going to be implemented, the so-called emergency aid. But if unemployment is high, inflation rates became another concern, and the slowness of the vaccination is is affecting these prospects. Whereas the U.S. has expanded a very generous plan for recovery, and China is probably going to have a very high GDP growth in 2021. So we're basically recovering for the effect of last year. When you put the three countries, what are some hot topics that we can foresee? First of all, Brazil is being pressured because it's environmental policy. So especially from Europe. And it's interesting when Professor Kaplan mentioned some issues regarding Chinese investment in Brazil, because we see everyday pressures on European investment funds regarding the compliance with policies to invest in Brazil, mostly in Brazil because of the environment. And we expect that from the new administration in the U.S., especially when we mention some issues like the border tax on carbon, for example, that's becoming an issue now on international trade. The second thing is the COVID and its impact, its long-term impact in Latin America, and how some countries are going to be more active because of COVID and to circumvent some of its consequences. Just to give you an example, China last week announced a package of $6 billion of aid related to the COVID, mostly to Angola, but to Ecuador and other developing countries are also going to receive Chinese aid. And then we have the issue of the coordination at the multilateral system, especially the WTO, but also the Brazil's intent to enter the OECD, which depends basically on the U.S. support. So we have some interesting connections here regarding how Brazil will depend somehow and sometimes on the U.S. and sometimes on China, and how it's going to look for some equilibrium not to be directly aligned and to avoid to conflict directly with one of these partners. So to keep within my initial thoughts and have some time for discussion, the three countries are key players in the multilateral trading system for many reasons, but of course they have their own intents and interests. In the case of Brazil, Brazil really wants to reinforce the system, but the current administration in Brazil is certainly more ideologically aligned with the U.S. When you look at the WTO and this new phase that is being proposed in the WTO, we have some conflicting views, both regarding the United States and the institutional evolution of the WTO, and regarding China and some proposals to reduce policy space and to reduce some measures that can be adopted by the WTO members. Let's remember, for example, that countervailing measures against China are expanding all over the world. More and more countries are using the Chinese subsidies in the domestic market as an argument to impose new countervailing measures. Then we have some of these hot topics like the definition of China as a market-oriented economy, which is relevant for trade remedies, the neo dispute settlement mechanism at the WTO and when it's going to be improved, the digital economy and pressures to national pressures to increase taxation on digital economy against the resistance from the U.S. and even some Chinese players. Issues of national security and the 5G is an example here. How Brazil, for example, is going to, on one hand, depend on Chinese providers for the 5G, and on the other hand, handle some concerns, especially among the military, regarding privacy and security for its data, and the environment, which is not an issue with China today, but is increasingly an issue with the United States. So, of course, we expect that the frictions between the United States and China we will move on, and it's probably this dispute is the dispute of this century, and it's not clear for us how Brazil is going to behave now and in the next administration. Of course, it's interesting that when I was representing Brazil as a trade negotiator, I was always impressed how the Chinese, they look at the long term, and they have the view for the long term. In Brazil, you always concerned about yesterday, and what we did yesterday, what we should do tomorrow, literally. So also just this cultural difference, it's interesting for us as a challenge for Brazilians to really define what are our long-term interests. So just some initial thoughts. I don't intend to be so comprehensive as Professor Kaplan, but I look forward to some discussion and exchange some more ideas. Thank you for the opportunity.
Thank you. Thank you very much, both of you, for your presentations. Both very insightful. Some interesting things to look into the longer term, the broader picture, and perhaps to contribute by how to Brazilian longer term strategies as well. To deepen on your views of some of the topics you've touched upon. So we move on now to some questions, a round of questions. Because of the time, we're hoping for 3 to 5 minutes for each question, but please feel free to answer all of them. So first of all, I think we should start with what lessons have we learned from the pandemic in terms of both global financial and trade flows? What trends we saw, particularly in the past year, and what we're seeing the plans for this year and for the short term that you believe might have longer term effects. So if you could start, Dr. Kaplan, and then Barral.
Sure, thank you. That sounds that's a terrific question. I'll start with sort of how Chinese financing investment might change moving forward, right? I think already, as Welber was highlighting earlier in terms of the 6 billion funding, right, that we see related to kind of health and vaccines that China has offered globally. I think that we're seeing a lot, like if you compare it to the 2008 financial crisis, right, where China comes in with a lot of really large scale investment in financing to kind of open the door and create those market opportunities. This time around, right, it tends to be kind of more led by health, right, and cooperation with health, sort of mass diplomacy. And so we're seeing, particularly in Brazil, right, a lot of cooperation in terms of vaccines, et cetera, as well. Now, I think moving forward, right, and compared to 2008, the nature of the flows are going to be a bit different, I think, right, that China may have learned a lesson as a creditor where these big state to state, this big indebtedness, right, in Venezuela, Ecuador, increasingly Bolivia, it looks like there's going to be restructuring, right? What COVID has also sort of shined a light on is the extent of indebtedness globally among developing countries. So China is maybe the world's best experimenter, right? One of the ways that they were able to have sort of the hyper growth years was through experimentation with lots of different instruments domestically. We're now seeing that experimentation internationally, right? And so increasingly they're moving from debt to equity. They have state-backed equity funds. They have as much as $40 billion in headline funds that they can use for the Latin American region. Of course, they've only distributed about $2 billion of that to date. But I think given the current situation, it wouldn't be surprising for them to begin to try to use those levers more than the state-to-state levers, right? So we're not seeing as much new loans to the region, even though state-to-state loans in terms of what's outstanding is the majority of what's outstanding. And I would expect to see more of this kind of state-backed equity financing, right? Kind of that kind of product that's similar to private equity emerging more and more moving forward.
Well, I'd like to emphasize also some lessons more related to trade. What I mean is, I think there were trade disruption at the beginning of the pandemics. And we saw some reactions. One of them was many countries tried to do stocks, especially of foodstuff. And Brazil, for example, exported a lot to the Middle Eastern countries because people were concerned about food security. At the very end, the trade flows demonstrated that they could be restored very quickly. But that left some lessons, one related to relocalization of production. So some countries are identifying, for example, production of medical equipment as a security issue, and they're giving incentives to reshore production of medical equipment. We are seeing that in Japan and in Europe, for example. Also, I think that there will be impacts for services related to trade. So the shipping industry is becoming more concerned about these unexpected events. The insurance industry is also reviewing its contracts and reviewing its conditions. So I think we're going to see some moves in this direction that's going to redefine the practice of trade regarding not only pandemics, other pandemics, but also other tragedies that may affect the humanity in the near future.
Looking at this is about U.S. Brazil, China. So what should we expect from the new U.S. administration regarding the global economy, China, Latin America? What role will the U.S. play in this playing field? If you can start, Barral.
Sorry. No, I think from a Brazilian point of view, we expect mostly predictability. I think the Trump administration was very erratic regarding its measures, and in some cases affected Brazil, like in the case of steel, of aluminum, and other trade measures which are mostly directed against China, but affected important exports to the U.S. So I think that the Biden administration will certainly use trade remedies, but in a more formal and predictable way. And of course, that gives time for negotiation, that gives time for defending Brazilian interests. Whereas in the Trump administration, we had some notice on Friday, and then on Monday, measures were already imposed. So I think predictability will be an asset for this administration regarding traditional trading partners like Brazil. I don't know if Stephen agrees.
Yeah, just a quick secondary note on that as well, just from my perspective as a sort of a professor and as a citizen, is that I think increasingly where we had a bilateral forum that took primacy over all other levels of negotiation. So if you had an interest, you on some level had to funnel it into that bilateral process. I think increasingly we'll see sort of forum shifting or a diversification of forums where we're already getting a very clear emphasis on multilateralism and alliances from the Biden administration. So I also think that we'll see things happening on a multitude of forums and a real diversification of the way that negotiations happen and a lot more emphasis on multilateralism moving forward.
It's Very interesting you brought that, because the next question is exactly on multilateralism. And a few years back, the whole concern, and Barral touched upon that on his presentation, was whether China could be accepted as a market economy or not. And it seems we have decided, or a lot of countries have decided not to discuss it. So we won't decide on it. What have we moved on from this? What role is China playing now on multilateralism?
Well, I think China is trying to sell itself as a new position, especially in the WTO. So if you look at Xi Jinping's discourse at the World Economic Forum, it was very impressive from the point of view of defending multilateralism and defending even the free market, free trade. So it's a completely different discourse that what we hear from China 10 years ago. How true is it? It's something that we have to see in the next years, considering the still very effective intervention of the Chinese government in its own economy and also some surrounding economies in the region. Well, from the Brazilian point of view, again, Brazil today, as you said, had decided not to decide. So when Brazil has to evaluate China as a market economy, it does by case analysis, especially on trade remedies. So it's still a pending issue regarding trade remedies in Brazil. And I think, as always, Brazil will try to be on the middle of any strong decision regarding this issue.
And in terms of the multilateral question, right, I agree with Welber's assessment effectively that, hey, listen, compared to the posture we used to get, we're getting a heavy emphasis on multilateralism, a stakeholder in the global system. You can even see the difference if you look at President Xi's speeches between 2017 at the BRI Forum and 2019. There's a lot greater emphasis on multilateralism. And the key question, of course, as Welber highlighted as well, is, well, to what extent is that credible, right? So I'll add on a stylized fact from the world of finance to kind of show the dichotomy here, right? We have sort of in the age of COVID, we have the DSSI, right? The G20's effort to kind of have debt forgiveness in developing countries, right? China sort of is a part of that. And sort of on the surface, right, you have this commitment to the multilateral mechanism. But at the same time, right, the sort of a two-dimension strategy, you have the CDB, right, the China Development Bank, that's considered to be kind of a quasi-commercial actor, right? So its indebtedness sort of is not necessarily included in that. And in fact, most of Latin America's loans come from the CDB. And so it views the CDB as kind of this quasi-commercial actor, but then you look at how is the CDB rated, right? From sovereign ratings groups, it's not rated as a private actor, it's rated as a government actor, right? It's a AAA rating. This helps, right, essentially give it an implicit subsidy internationally. So, but what is it then doing through its CDB loans? It's negotiating all those loans bilaterally, right? So you kind of have two dimensions occurring where, yes, you have this commitment to multilateralism in the world of finance, but also where they have a big stake, there's also this emphasis on bilateralism, right? And I think in some ways, I mentioned forums and diversification forums on the United States side. A very similar thing has been happening for a while on the Chinese side, right? Where we see increasing efforts in multilateralism, working with the World Bank, working with more multilateral partners, but there's still sort of this bilateralism that emerges among its policy banks simultaneously.
Great, thank you. And moving on from that, where do you see the greatest risks of economic maybe political conflict between the US and China, well, at the multilateral level and within Brazil over the next years? So can we expect, for example, retaliatory actions from either side?
Stephen, can you begin?
Sure. So yeah, so I think in terms of where the likely conflict is, I think, even though a lot of press is given to sort of this infrastructure financing historically, I think, as I mentioned, increasingly that's going to be channeled possibly through more of the competitive bidding structure, more of a market-oriented structure. In some ways, right, Brazil's really well positioned for that because you have sort of a very good procurement system, a very established procurement system, a recent reform of that system with the PPI as well. So there, I think in some ways that traditional infrastructure is less the inflection point, right? Notwithstanding sort of sometimes broad overtures that you get in response to that from the United States, I really think the main area, or the most likely area for more traditional or more tensions to emerge is in areas of telecommunications, 5G, sort of the infrastructure moving forward. So the extent to which China has its 2025 plan, and China wants to kind of emerge as a world leader in technology, you even see it in terms of where it wants diplomacy and relations with the region to go, and wants it to move from heavy infrastructure and energy increasingly into the digital economy, right? And I think that's where the most likely tensions are to merge moving forward. We've already seen those tensions emerge to some extent with Huawei as well over the course of the last year.
Yeah, I agree. I would like to add some thoughts on that, because basically Brazil has lost its relevance and its protagonism in the region as giving fund through BNDES to large infrastructure in the region. Brazil lost it because of Lava Jato and the corruption scandals. So it will depend more and more, even on Chinese investment for infrastructure in Brazil. As you all know, especially on energy, China has been very active in Brazil. So and the other thing which is important is that, as Stephen has demonstrated, most of this funding doesn't have conditionalities, whereas we see more and more issues regarding European funding with conditional clauses related to the environment and political issues. So this scenario is probably going to make China more important as a source of funding for infrastructure, not only in Brazil, but also in Latin America.
We are running out of time, so I'll try to put together some of the questions that we got in the Q&A chat and kind of a closing question. And on the one hand, if you could touch upon how the how the EU and Brexit affect this scenario. And I think Bahal already brought one of the aspects for that. And on the other hand, how can Brazil navigate this scenario? So a lot of questions come about whether Brazil might lose. There is a risk of Brazil losing opportunities with trade with China in terms of commodities, for example, in competing with Africa. Dr. Kaplan also mentioned the conditionality involved in investments. So there are risks and opportunities involved in the relations with China. How can Brazil navigate that?
Well, it's interesting when you look at the Brazilian history. At many moments in Brazilian history, Brazil tried to be neutral. For example, the Second World War, until at the last moment they joined the forces. But Brazil tried to be neutral most of the time and receive investment from both sides. And that's something that is still in the Brazilian mentality, that it could still navigate in this world, which is not true, because Brazil is too big to hide itself. And on the other hand, it's too risky to opt for one side or the other. So historically, of course, Brazil has an alignment with the United States, and there's an ideological alignment with the United States, especially in this government. But in the long term, we have to see that Brazil will have to look for other opportunities, not only with China and the Asian countries, but also with Africa and Latin America. And what we see today is that Brazil is losing market and competing with Chinese manufactured goods, mostly in Latin America. And Brazil doesn't have the capacity to finance and mechanisms of trade finance that the Chinese and even the Indians have today in Latin America. So that affects Brazilian exports of manufactured goods, and something that we should discuss more about. In the long term, the country also has to do some decisions regarding how to make our industry more competitive. Part of our problems regarding exports of manufactured goods are related to the lack of competitiveness of Brazil itself, its tax system, its logistics. its complications, bureaucratic paperwork, things that we have to change in terms of being more competitive in the region. And let's note, for example, except for Argentina, which has in Brazil its main trading partner, all the other Latin American countries are having China more and more as the main trading partner. So not only have to compete with the US, but with China as an important provider of manufactured goods in the region, and we are losing. So that's something that we have to think as something crucial for the future of the Brazilian industry and its industrial capacity. And I'd like to close here, and I thank you, Verônica, for the opportunity and the opportunity to discuss with you, Stephen.
I'll just quickly add on two stylized points. The first one being, in terms of industrial policy and infrastructure, right? I mean, those are two things that the region has put less emphasis on in recent years, but moving forward are quite important. But comparatively, right, savings rates in the region relative to East Asia are a lot lower, right? So I would like to second that point, right, in terms of not necessarily having the same level of financial capacity to push, of a large scale industrial policy or infrastructure policy forward, hence the reliance on the private sector, right? Hence Brazil's reliance simultaneously on the private sector. That said, I also think Brazil's in a unique position, right? Because on some level, when you think about, to what extent, there are tensions between China and the United States, Brazil in a lot of ways in its model has elements of both countries, right? Elements of both countries' approaches to the market. So Brazil could be in a unique place in terms of helping craft solutions to these problems, right? As we see sort of increasingly Europe and the United States turn to investment restrictions, or increasingly, as you mentioned as well, using potentially countervailing duties through the WTO, right? But thinking about the best way to kind of craft solutions, I think Brazil is actually in quite a good place moving forward to help with that process as well. So that's, I think, sort of some key points to think about moving forward.
Well, we're really running out of time. I've seen that my good friend, Professor Paulo Ferracioli, is online, and he remembered me that he's always telling me how we have to learn more about China and Asia. And he's been saying this for about 5 to 10 years to me. And I truly believe we need more discussions like this and to go in deeper detail to understand this massive partner of ours. We have zero time left for final conclusions. So I'd just like to thank you very much for your talks, and thank you all participants who joined us live today. I hope you have enjoyed it.
Thank you very much, everybody.
Thank you, bye.